assisting me. Hi guys, welcome to my channel. So today I'm going to be doing a Q&A on stocks and shares, and the reason why is that I recently did a Q&A on Instagram Live and it was really successful, so I thought it might be better just to have a recap over it on YouTube. So stay tuned. So if you hear the noise in the background, that's my lovely wife reading out the question from Instagram Live. So let's crack on.
So yeah, hi guys, can't see me. So the first question is, how do you know what shares to invest in?
This is a really good question, and I think it's a really important question. The reason, how do I know what shares to invest in, is very much based on the financial integrity of a company. That's what underpins a company, is how much cash the company generates. Cash is king when it comes to choosing what company to invest in. So what's really important that you have to do is making sure that what the company says that they're generating profit is actually converted into cash. The reason why profit is a book figure, it's just a figure on a piece of paper. It's saying that you sold this and these are all your costs and that's how much you have left over. While cash is totally different. Cash in the bank, like any other person, is probably something that you can't fake, you can't fudge. Is that if it's in the bank, it's real. So when a company says that they've produced profit, what I want to do is confirm that they've converted that into cash. And what I also want to do is that they've been able to do that consistently, but not just consistently. By consistently, I mean over the course of a couple of years, and by years I mean about at least 5 years, but 5 to 10 years. But they've been able to grow it, and that's really important as well. Growing that cash, growing that profit, and converting that profit into cash is so important, and consistently over 5+ years is really important. So those are the things I sort of look for. And another thing I look for is also that when I invest for cash, I invest for dividends. I want the company to be able to distribute its profits back to me. And so I look to make sure that they are also paying the dividends and that the dividend is growing at a sustainable rate and over the long term. So those are the sort of 3 areas that I really look for when it comes to investing in a company, deciding what company to invest in.
So what are the top 3 things you use to quickly assess whether or not it is an advantageous or disadvantageous market to invest in?
So the 3 things. So the first thing I'll probably say is that you need to be able to actually measure what the market is. So if you're looking at the market, how do you know whether the market is up or down? What metric or form of measurement do you use to give you an indication of how the market is doing? And so that's really important. So you have to have some sort of metric to measure. Measure is very important. Without measuring something, how do you know what it's worth, or how do you know where it is? So what I would generally look at is, how can I measure the market? And the most simplest and easiest way to do that in the industry is known as an index, or market index. Now, a market index is purely a representation of the state of stocks within a specific index. So, for example, the FTSE 100, which is the UK index. The FTSE 100 is literally an overall average of all the top 100 companies in the UK. So if you can imagine the top 100 companies and their share prices and the volume of their shares all amalgamated to one sort of metric, that is the FTSE 100 index. And so let's say, for example, the FTSE 100 index is 100 today, and then it's 100, it's 200 tomorrow. So what that showed me is that on average, those top 100 companies have grown in value. Of their market the market is grown in value from 100 to 200 by 100%. So that's a market indicator that I would use. And so if you're looking at the market, you can look at it sort of locally, which is like the FTSE 100 for the UK, or you can look at it across globally, or in other markets such as the CAC for France, which is the index for France. Or you can look at the DAX for Germany, the S&P 500 for the US, Russell Dow Jones, etc., etc. So these are all ways you can measure how the market is doing. So then what you need to do is a really other important question, which is, well, if you know where you're going, first you need to know where you started. And so you need to be able to identify, well, how are you actually measuring where the market is based on a reference point? You need to have some sort of reference point. So I can't assume the market's moved up if I don't know where the market was before. And so what you really want to do is assess, well, what are you measuring against? What moment in time are you measuring against, to see whether there's an opportunity within the market? And so usually what people generally do is they look at the peaks. So when was the market its highest, and when is the market the lowest? And that gives you a good indication of whether there's opportunity to take advantage of the market, because you can see that that was the highest it's ever been, and this is the lowest it's ever been. So if this is the highest ever been and this is the lowest ever been, surely it's an opportunity for you to jump in and take advantage and buy some shares. Now, another thing, and I think is really important, and this is something that I practice, is I'm not really a fan of share prices. The reason why is that share prices can be quite misleading. It's all sentiment. It's all someone selling something for what they think it's worth, or someone buying something for what they think it's worth. It doesn't actually generally represent the underlying business. And I'll give you an example. For example, imagine if Coca-Cola produced 100 bottles, 100,000 bottles for £1, so £100,000, and then their share price crashed, and yet they're still producing 100,000 bottles for £1. The share price, drop in share price, isn't reflective of their business. They're still generating cash and probably even growing it. So what is really important to do is to check that the business, the underlying business you want to invest in, when the price is dropping, you want to take advantage, is still beneficial, still generating cash, it's still profitable. So it's not just it's just not a matter of seeing where there's an opportunity and buying. It's also making sure that the underlying asset, the underlying business is still generating cash, is still profitable to justify its price and for you to justify to buy at such a low price.
What do you think about investing in big brands right now, given the current climate that we're in?
I'm not really a fan of investing in big brands. The reason why is that marketing and business acumen are two totally different things. Just because branding is marketing, because you're good at marketing doesn't necessarily mean that you're a good business. And I think this is testament to a lot of the businesses that have recently failed in the past couple of years. And these companies had really, really powerful name brands. So Debenhams crashed. Mothercare, big brand, crashed. The list goes on. Toys R Us, amazing. I remember shopping at Toys R Us, crashed. So the brand to me doesn't represent, is not a good representation of the business and the reason to purchase shares within a business. Again, I go back to the first question, which was looking at the financial integrity of a business, absolutely crucial. And to be honest, a lot of the businesses that are the most profitable in terms of the most profitable and cash generating profitable, and by that I mean they're converting their profits, they're growing their profits, they're converting it to cash, are companies you've probably never even heard of. They're companies that mainly deal with business to business rather than custom to business. Brands are mainly associated with customer to business sort of industries, while the most successful and profitable companies, the general public probably never heard of them. So brand names to me are helpful, but they are no reason or justification as to why you should invest in a company.
What books can I read to get a better understanding of how and when to invest?
So, well, to be honest, when I first did my first video about this, I said knowledge is the most value because the knowledge shows you where there's opportunity and how to take advantage of that opportunity. And some of the best books, and what the books I like to read are books that are very simple. And so there's one book that I read when I first started out, and I think it's extremely helpful. And I always tell people to read this book if they want to get into stocks and shares, which is Rodney Hobson, Shares Made Simple. Really good book. Very helpful in explaining shares and their terms and how the industry works. So I'll definitely recommend that book if you're starting out. There are also books on Morningstar has a book on. They have a book series on mutual funds. So and mutual funds are sort of are stocks, but they're a basket of stocks. So it's like a company that buys a basket of stocks, and you buy one share of that company, the mutual fund. And so you own one share of that mutual fund, and that one share is representative of all the stocks that is within that basket of that mutual fund. So Morningstar have a few books on funds, which are really helpful as well to help you get involved in investing. Another thing I would say is that knowledge is in all different ways and different forms. You don't necessarily need to read books. They're helpful, but YouTube, just as you're watching me right now, that's so helpful. So if you're not a fan of reading books, YouTube. If you're not a fan of listening to YouTube, podcasts. Another thing I'd also really promote is watch business news. It's so helpful. It really does give you information on how the markets are and how they're working. So it's a form of knowledge that you're taking in. And then newspapers, the Financial Times. I read the Financial Times all the time. The Economist as well. So read financial orientated newspapers or articles. They really do help. So just not books, but all the other mediums as well, you should explore.
Lastly, what would you recommend for beginners and those who don't have time to look into companies? What would you recommend that we can use to get into investing?
Well, I'll say well done, because the fact that you actually want to start is a good and positive thing. So there are companies out there that offer very low, simple sort of investment platforms. I think one of the companies, there's Nutmeg, and I think there's another company called Moneybox, I think, or something. And so what these companies do is that they offer this sort of like portfolio baskets, so portfolio red, amber, and green, and portfolio green is the least risk, portfolio amber is medium risk, and portfolio red is high risk. And the rate of return that you get from that investment is reflective of the risk. I think it's really good. I think it's really helpful. I think they will introduce you to stocks. However, I would also say that, like I mentioned, the value of stocks is not the monetary value. The value of investing is not the monetary value, it's in the knowledge. So when you invest in these areas, do it in these sort of organizations or these sort of portals. Do it with the understanding that you're going to acquire knowledge yourself so you can invest yourself. That's where the true value is, because without that knowledge, you can't see where the opportunity is. And if you can't see where the opportunity is, you can't seize it. So that's one of the things I would say, is that if you are planning to go down these routes, also read on the side, learn investing, how to invest on the side, read books, gain the knowledge so you can do it yourself and independently. So hi guys, I hope you enjoyed the video. Please do leave comments below. Please also like and subscribe, and I'll see you soon.